All right. Seeing some folks coming in here. We're going to give everybody just about a minute or two to get in, get their audio set up. And once we see the attendees sort of plateau here, probably in 60 to 90 seconds, we'll get started. But we're excited to have everyone. All right. We're climbing here. I think we can just about get started. Um, all right, let's do it. Hey everyone, very excited to have you here, and for this amazing, first of many Coast webinars where we focus on really just leveling up your business. And by way of introduction, my name is Zach Meyer. I'm the Chief Revenue Officer here at Coast. For the uninitiated, Coast is a fuel card and an expense management offering for fleets. We make life a whole lot easier for businesses that own fleets of vehicles, to close their books at the end of every month, but also just make sure they're saving money on fuel. And really, at the end of the day, it's a smart corporate card for anybody who has fuel or EVs or fleets as a major expense. But that's not why we're here. Not necessarily here to talk about Coast today. Today, I'm really excited to introduce Tom Poltersdorf here. Tom is the owner of Beyond Your Exit Wealth Management, and really Tom is excellent in specializes in helping business owners like you all plan for a successful exit. And so I'm going to pass it off here to Tom, who's going to talk a little bit about how to get everything together and prioritize your business and position it so that you can plan, for a successful exit. Tom, you want to take it away?
Thank you, Zach. I appreciate that intro. And yeah, welcome everyone. And thank you for joining me today. My promise to you during this webinar is very simple. And I'm going to give you actionable steps to maximize the value of your business, show you how to avoid common pitfalls that can cost you time and money, and most importantly, how to transition into a life of purpose and financial freedom post the sale. And I want to be clear about the strategies that I'm going to talk about today. These aren't just theories or generic advice. Whether you're running a service-based business, whether it's manufacturing, HVAC, plumbing, whatever the business it is, the principles of exit planning are universal and they'll work for any business. And I know this because I use them with my own business owner clients, and they're proven methodologies grounded in research conducted by organizations like the Exit Planning Institute. Another one is Tiger 21, which is an entrepreneur peer advisory group. So yeah, a lot of these are grounded in research. Now, the big question, why should you be listening to me today? I bring over 15 years of experience in financial planning to the table. I have various designations that are listed below. But more important than those is this is literally all I do. Hence the name of my firm, Beyond Your Exit Wealth Management. And that's having a mission to help business owners like you plan their transition out of their business and manage their wealth. And it's also just help you step away on your terms with clarity and confidence about your future. So what I'll share today isn't just about selling a business, it's about creating a plan that aligns with your goals and what's most important to you. And click one more, Liz. Keep going there. So, all right, with all that being said, let's dive in here. So here's what we're going to cover today. Why planning your exit is critical, the common challenges of not having a plan, the three components of your exit readiness, the key steps in creating a successful exit, and then how to position yourself for financial freedom after you exit. So each of these topics will build on the other. I have a lot to go through, so stick with me, but I can promise to you by the end, you'll have a much better understanding of what it takes to maximize value and exit on your terms. And so I want to kick it off with some key statistics, pretty wild statistics, in my opinion, provided by the Exit Planning Institute. But Did you know that only 20% of businesses listed for sale actually sell? That means 80% of owners don't achieve their goal of exiting or slowly transitioning out. And on top of that, over 75% of them regret their decision within a year of selling. Now, the most common reasons for these are because they didn't get the best deal, they were not ready to fully leave the business, or they didn't plan well enough for life after and how they would spend their time. So there's not only a monetary cost with the risk of leaving money on the table, but there's an emotional cost if we're not personally and mentally ready to step away. So whether you're thinking of exiting in 2 years or 10 years, proactive planning will be essential to maximize your net proceeds and the value. And we'll dive into more of those details shortly and how we're going to do that. So let's talk about the consequences of poor planning. So another crazy statistic here. Did you know that 50% of business exits are involuntary? That means 50% of owners are forced to exit, usually because of dramatic, unanticipated life events. And we call these the 5 Ds. So that's death, disability, divorce, disagreement, and distress. So these are all unexpected events that force many owners to exit under less than ideal conditions. So think about this. You're 60 years old, you are ready to exit, and you're ready to exit. And by planning ahead, you could protect everything you've built. So let's say you're planning to exit there and you don't know what to do. So how should you be thinking about the transition? Oh, wait, another slide here. So you have 5 year, yeah, the three legs of the stool. Sorry there. So three legs of the stool. So here's an easy way to think about this. Okay, let's back up. So we have personal readiness, we have business readiness, and we have financial readiness. So think of it like this as the way to attack this. Each leg is critical for a successful exit strategy. So if you're missing one of these legs, okay, what happens to the stool? It's going to fall over, right? So this applies to your exit strategy. Now let's break each of these down even deeper. So we have personal readiness, which is we plan personally for what you'll do next. We also have business readiness, which is about maximizing the value of your company. And then we have financial readiness, which is about ensuring you have the resources to support your desired lifestyle after the sale. So alignment of all three of these will be a key pillar for a successful transition. So let's break each of these down even further into actionable items you can start working on as early as today. Okay, so we're going to start with personal readiness. So personal readiness starts with understanding your personal goals and defining what's next for you. So think about this. Here's what I was going to touch on earlier. If you sell your business at 60, you might live another 20 or 30 years, right? So how are you going to spend your time? And no, you just can't play golf. I've spoken with and interviewed many owners who have gone down this road already and gone down that exit path. Golf will only take you so far. Now, I also realize this isn't easy. And it's very common for us to struggle between separating our personal goals from our business goals. Back one up there, Liz, please. To the visual. Yes, here we go. And I'm just going over the struggle between separating our business goals from our personal goals, because let's be honest, business is personal, right? They intertwine together and play a significant role in not only what we do, but who we are. So on the next slide, I want to share several exercises that we guide owners through. And you're welcome to copy this, take a screenshot. I know you're all going to get a copy of the recording to do this exercise on your own. But the first is to break down your ideal week, hour by hour, for each day, as if you've had all the resources you need to live exactly as you'd like. So there's no money limitations and there's no time limitations when thinking through this exercise. Next one. The next one is your typical current week. So we want to write out what we're doing today by the hour, every day of the week. And then at the end of this, we want to ask ourselves, how am I prioritizing what truly matters? What am I actually spending my time on? And then moving on to the next slide, we then zoom out and look at our ideal year. So this is the same concept, but we're going to describe from month to month, how would you spend your ideal year? Again, keeping in mind, you have all the resources you need, all the money you need, no time restrictions. And finally, one more. a typical current year. So this is where we're going to write down what we're actually doing year by year. Again, same thing as before, but actually what we're doing this year. Now, when you go through these exercises, we go through additional questions and actually have a dialogue about it. We often discover that our time, money, and attention are not aligned with what's most important to us. And so on the next slide, with these exercises, they'll actually help you identify and prioritize your personal goals first, then align those goals with your personal financial targets, which I'll discuss more shortly. And finally, moving down to your business goals, which drive everything to make it all happen. But now your business will start working for you as opposed to you working for your business. Go back one more, Liz. There's a lot on this one. Thank you. I can't stress how important this is, though, because here's what actually happens. Many owners face an identity crisis after selling because they've tied their self-worth to their role in their company. Some go through the entire exit planning process only to get to the table with a buyer for a potential sale, to then only walk away from the deal because they weren't ready. So I recognize this is difficult to do, and many of you I know will put this exercise on the back burner, but I assign this to most people, and many actually come back with these sheets completely blank. I also give this to some folks, and they're completely filled out because they're ready to rock and roll for their next chapter of their life. So everybody's different, but going back to the three legs of the stool, you can have a very valuable business. You can also be financially ready. But if you're personally not ready and your identity is still tied to the business itself, that's where people get cold feet, walk away from the deal, and then we have regret. So we can't skip personal readiness step. Go ahead, Liz. Okay, now the fun stuff. So this is business readiness. So this is all about maximizing the transferable value of your company. The key word here being transferable, which is how valuable is your business to someone else if you're no longer involved. Now, many businesses rely too heavily on the owner, which can be a huge red flag to buyers because if something happened to you, the business would either go under or severely struggle to stay afloat, right? So to make your business more attractive, the key is to work on these key value drivers, which on the next slide, I actually show you 8 of them. And we're going to go through each of these briefly, and we're actually going to dive into 2 of them in depth in the coming couple slides. So let me run through these real quick, starting on the next slide here. Okay. So the first is financial performance. So the financials are easy to understand, but very difficult to deliver. So that's your top line revenue and your bottom line profit, not only what those numbers are, but the quality of the reporting of those numbers. And we're going to dig more into this shortly again in the next coming slides. Then we have the Switzerland structure, which comes from the idea of Switzerland and how they have this passion for being very independent. And independence is essential to having a saleable company. And here's what I mean by this. It's about avoiding concentration issues. So not depending on 1 or 2 of your biggest customers to bring in the bulk of your revenue, not relying on any one key employee to run everything in the business, and not being overly dependent on any one supplier. So being diversified across all 3 of these will not only lower your risk, but increase your attractiveness to a buyer. And then we have recurring revenue, which a lot of you probably know what this is. For trades businesses, this would be maintenance agreements as an example. But recurring revenue really helps with forecasting and the likelihood of future cash flow. And it also adds a ton of value. Next, are we still showing slides? I can keep continuing here. So then we have
I think we
customer.
had a small malfunction where Zoom shut down, but you go ahead and keep going, Tom, and we'll get the slides back up in a second.
Okay, I got it here in front of me. So the last one here is customer. Oh, there we go. Customer satisfaction on the bottom right there with the stars. So this is the Net Promoter Score, which helps quantify and measure client satisfaction. So I'm sure a lot of you folks have seen this before. If you go onto a website, the little box comes up and it asks you to rate on a scale of 1 to 10, how likely are you to recommend someone to use their service? That's the Net Promoter Score. It helps quantify and measure client satisfaction. And obviously, the higher the Net Promoter Score, over a longer period of time, that can benchmark the performance and show the likelihood that customers will recommend the services and come back or buy your products, for example. So next, continuing with the last four here real quick, we have growth potential. So the biggest misconception I see with growth potential is that owners are really proud of what they did in the past. Business accomplishments, maybe you've been in business for 30 years or so, but the hard truth is a buyer is not buying the past. They're buying the future stream of profits in the business, right? They're thinking, what is the future potential of this company? Can it operate in a different market? Can we cross-sell products to existing customers, or other ways to scale in markets A, B, or C? Then we have valuation teeter-totter, which if you can imagine here, it's a picture of a seesaw. If you can imagine a little kid on one end and then the bigger kid hops on, it bounces back up, right? The same relationship exists between the way cash moves through the business and its value. Essentially, when a buyer comes in to buy a business, they're going to write two checks. One goes to the owner, and the second check is to fund the company's working capital. So the more cash the company sucks up and needs to operate, the less they are going to be willing to buy the business. So we want to make sure the business is generating cash. And as an example of this, if you're collecting receivables, if there's a way to collect more upfront, collect them faster, that's going to make you look better to a buyer. And then we have monopoly control. So this is how do you differentiate yourself? This gets into the marketing strategy. This gets into how you communicate your messaging. And essentially, you want to ask yourself two questions. Does this make us different? And do our customers care? The better answers you have for both of those will help increase your value. And finally, we have hub and spoke. So this is how dependent is the company on the owner personally, right? The idea is the owner is the hub and the spokes represent everything coming back to them. So when employees come to you to ask a question, you have customers coming to you when they need a quote. Do you have suppliers coming to you when they want to buy something? And we're going to dig more into this in a couple of slides on how to fix it, but that's a big one for a lot of business owners out there. Go ahead, Liz. All right, so this slide is a quick visual of two companies, okay? If you look at the top, they both have the same financials, but when you look underneath the hood, these companies are very different. And my question to you is, which one do you think has transferable value? Company A with no CRM system, worn equipment, little employee training, or company B who has a strategic plan, they have pristine equipment, documented processes. Which one do you think is going to be more valuable? It's going to be company B, right? I think we can all agree on that. But the point is, if you have a profitable business, that doesn't mean you have a saleable business. And listen, if this is you, that's completely okay. If you're happy in your role, what you do, you're making good money, you have good employees, that's all great. Just understand, though, that if the day comes when you need or want to sell, it will be very difficult to make that happen without doing any planning. Go ahead, Liz. So for most of you on this call, owner dependency will be your highest priority. Think about it from a buyer's perspective. Go back one more. Oh, that's fine. If you are the one making the sales, if you are the face of the company, if you're the one in the truck going to the appointments, would you want to buy that business? Highly unlikely, right? Because if that owner leaves, everything's going with him. So there needs to be a mindset shift. Go ahead, Liz. Can you next slide, Liz? Thank you. So there needs to be a mindset shift going from owner operator, so being involved, you're very hands-on, to going to taking a step back and becoming an investor. So putting your time, money, and attention into big picture strategic planning for the business. Now, this doesn't happen overnight. I'm going to be honest, it could take a lot of time, but where you start depends on the state of the business. So I highlight 7 of the key processes here where you can create SOPs, which are standard operating procedures, and they're all centered around building and managing your team, which will allow you to delegate more and surround yourself with a quality, reliable team, hopefully giving valuable time back to you. This is called building human capital. Now, because you've defined and documented how to do it, hire, what metrics that you hold your team accountable to, how to recognize your rock star players, this all spills over into retention and keeping good employees. And listen, I get it. Retention is very hard. I'm working with a couple businesses now where they have a lot of older employees in important roles, and they need to find ways to backfill those positions just in case they decide to get up and retire, right? So, as an example, let's take hiring for an example. Have you identified the type of person you are looking to hire? How do you let the public know you're looking? What's your vetting process? What's your onboarding process? How are you training them? And is that all systematized and automated? The more detailed the process, the easier it will be to delegate. One more. There we go. All right. So, and the last one here that I want to touch on is having clean financials that are defendable. And every time I talk to an M&A advisor, they always say we need to have clean books and records. Again, one of the biggest things to have before going into a deal. And I'm actually going to pass this off to Zach because they help with this process, cleaning your financials, which in the end will have you end up with a higher, bigger payout, more acceptable to more buyers, and will make you a heck of a lot more attractive. So, Zach, take it over, man.
Yeah, absolutely. It's a funny thing. We talk to a lot of business owners, who are in the midst of acquisition. It's actually one of the biggest changes that we find when we monitor like our portfolio of customers at Coast. Things get like disrupted, and we look and we call someone up. We say, "Hey, what's going on? You stopped kind of spending on your card today." And they say, "Oh, well, actually, we were acquired, and now we are part of this bigger company, or a private equity group owns us now, and we work with them instead." And when we talk to these folks, there's always one very common through line, right? And the idea is that they're more obsessive about clean financials and making sure that they have an operationally efficient business. They're making commitments that help their bottom line, rather than ones that maybe in the early days of the business might look like it's about helping themselves. So, like, as an example, they care more about having like an excellent accounting process that helps you close your books faster at the end of every month, or have more accurate reconciliation processes that played more effectively in their acquisition than, let's say, getting points, for an American Express card. That helped them in the near term, but they ended up making a whole lot more money by selling their business down the line because they had really clean books. And so, those are folks who come to Coast, right? And when Coast is, your corporate charge card, it's your credit card that you use for all your fleet expenses, or maybe all of your expenses, because we're on the Visa network and you could use it as your entire corporate card. There's a few things that really help when it comes to this acquisition. First, it's all about boosting your bottom line, because we reduce your fleet costs. On average, Coast customers save 10% on their fuel bill, and a whole lot more on everything else that they spend on, right? You eliminate fuel fraud. We decrease the amount of time you spend dealing with your fleet related expenses. No one got into the business that you guys are in to have a fleet. You have to have a fleet. It's a consequence. And so if you can show acumen, you can show and prove to someone who's a buyer that you are an efficient shop, and minimize costs, that's what they like to see. Additionally, you have better reporting, right? You have accurate books. You can use features like Coast has for job codes, automatic captures of receipts and memo collection. When you go through an audit process and all of your receipts are attached to every single transaction, and all of them have memos. This was for this job, or this purchase for this amount. It looks like you run a tight operation, right? And then, generally speaking, the big thing is when you reduce the time that you're spending on your fleet and on your corporate card expenses, generally speaking, Your admins, your controllers, even your CFO, they can spend time doing stuff that matters more, right? They can spend time negotiating with vendors to get better discounts. They can spend time getting books in order and on strategic projects that are going to help the value of your business, not trying to figure out why Jeff spent $43, at this station instead of that one, right? And so what Coast does, it gives you actionable insights, outstanding integrations, and helps you close your books faster, and helps you sort of appeal to the narrative of these acquisitive businesses that, hey, you're a shop that has their books in order and you bias towards efficiency, and that's what people want to see.
Awesome. So moving on here to financial readiness, the last leg of the stool. This means planning for your desired lifestyle without relying on the income from the business. So just as you have a balance sheet for your business, which is a current snapshot of everything going on with your finances, we also need to know what's going on with our personal finances. And that's where coming in, having a personal balance sheet starts. That gives you a holistic perspective of where you're at. So many of us know more about what's happening in our business than we do in our own personal bank accounts. So on the next slide, there's actually an example of what this looks like. And it's just taking the time to organize your current assets. So going down the left-hand side, taxable brokerage accounts, pre-tax, tax-free real estate in your business. And then on the right-hand side, it's all of our debts. All right, so short-term, long-term debt, which is credit cards, mortgages. And when you actually do this, right, the difference between the two will give you your total net worth. But what's very common among a lot of business owners is close to 80% or more of your total net worth will usually be tied to your business. We can see that here in the dark blue. Now, although that's quite an accomplishment, like this company here has a $3 million value, it presents a major risk because the likelihood that that company also has a $3 million transferable value to a buyer is statistically quite low, meaning $3 million is locked up in a potentially illiquid asset, right? And so here's what happens on the next slide there. There we go. Here's what happens. So we're clear on where we're at today, right? If we look at the left-hand side of this in our current state with our personal finances, the value of our business, we now need to look at the right side of this slide, which is our future state. Where do we want to be financially 5 to 10 years from now? Where do we want to live? Do we want to move closer to the kids down south, start a new business, etc.? These are all questions that need to be answered, and often they tie back directly to what we did earlier, the exercises that we talked about in the personal readiness step, filling out how we want to spend our time. We then quantify how much we need in a bank account to make all this happen, right? Everything we want to do in our future state. And the majority of the time, there's going to be a gap between where we're at and where we want to go. And the gap can be because of multiple reasons, but the most common being that we're not saving and investing enough outside of the business, building wealth separate from the performance of our company. So, i.e., 401k, IRAs, brokerage accounts, real estate. And the other reason is not knowing the true value of our business. So, we're either guessing or there's no transferable value. And so, there's really only two things we can do to close the gap. We can save and invest more outside of the business. We can get a business valuation and increase the value of the business. And usually it's going to require us to do both. So that's going back to working on those value drivers, right? To increase the attractiveness of our company. That's making sure you are contributing to retirement plans, buying real estate, investing in things separate from our company. It could also be making it a priority if you're a newer business to actually set up a retirement plan, or if you're a big spender, maybe it's time to evaluate your expenses and start prioritizing putting enough money away on a monthly basis. So ask yourself these questions. Do I know how much I need to live my desired lifestyle after a transition? Am I on track factoring in taxes, inflation, and expenses? Am I depending on my business to fund my retirement or the next chapter of my life? And if so, is my business truly worth? Does it have transferable value? Now, another thing to consider on this slide, especially for financial readiness, is how much money is going to end up in your pocket after a sale. right? What are those net proceeds going to look like? And so starting on the left-hand side here, we think we just have capital gains taxes, right? And again, this is very high level. We can get very detailed on this, but we think there's just capital gains taxes, which is 20% for long-term capital gains tax, which brings us 2.4 million on the left. But there's so much more that goes into it than that. If we look at the right-hand side, again, we have capital gains, but then depending on where you live, there's state taxes. In this example, it's California at a 13.3% state income tax, giving us our 2 million. But then beneath that, these are actual real examples from a deal that went through in January. Money could be left to your employees. Money could be held for 90 days contingent on sales performance. Money could be held in a escrow account for 24 months just to protect against any lawsuits that could come out of the woodworks after a sale, right? So I'm sure many of you are probably thinking, how are we supposed to manage all three legs of the stool, do all of this on top of running a business and having a personal life? And that's why on the next slide, it's so important to be proactive and start building your professional team. Exit planning is not a solo journey. Business owners who have successfully gone through the exit planning process have a team of experts, which include a business attorney, CPA, certified financial planner, and potentially a business broker or M&A advisor. The sooner you start planning for the transition from your business, the more options you're going to give yourself. You'll give yourself more time to find the right people. You'll give yourself more time to put them in the right place, have the right experience, and to get you the outcome you most want. So to summarize, here are the key steps to strategic exit planning. Click, there we go. So define your goals, personal, financial, and business. We want to understand our business value, get a business valuation. We want to prepare the business for sale, which is working on those 8 value drivers. We want to choose the right exit strategy, which here is sale, merger, or transfer. And we didn't dig a lot into the actual exit strategies. There's literally 10 different ways to exit or transition out of a business, but you'll get more details on those I explained in the free exit planning playbook that everyone will get with the recording of this call. And last is plan for wealth management post-sale. So minimize taxes, create an income stream from the net proceeds while protecting your legacy. So each of these steps build on each other, but it's just so crucial to start early and stay intentional to get the planning done. And so before we wrap up, let's quickly review some of the common mistakes to avoid. Number one, waiting too long to plan. Just because we don't have any intention to exit within the next 5 years doesn't mean we should put this off. What owners often find is when you start exit planning, you fix the business so much and you become so much more organized on your personal and financial planning side, it actually becomes easier to run. And many at that point choose not to sell because they're not tired, they don't have burnout anymore, and they start to enjoy the process again. The second common mistake is ignoring personal financial planning. In my experience, business owners often put the needs of the business before themselves. They end up putting their own personal and financial future at risk when they do this. Yes, the business is your biggest asset that should have all of your time and attention. 100% agree. But we can't sideline our personal financial planning as well. And finally, the last mistake is failing to engage expert advisors. So you don't want to go on this journey alone. Selling your business will most likely be the largest transaction of your life. There's a very rare chance that you're going to have a second chance down that road, right? It's very unlikely to get a second chance at selling. So you want to get it right the first time. And so with that, thank you so much for your time and attention. I hope you found this webinar helpful. And Liz, I'd be happy to address any questions if we got any.
Thank you so much, Tom. I think that was really, really insightful. And we have a couple things here. So I see a question in the chat that we're going to get to, and I want to make sure that people can ask questions. You can either use the Q&A button at the bottom where you can ask questions, or the webinar chat. Both should work. So please feel free to either raise your hand or type into that chat. Definitely easiest. And then before we get to the chat, I do also want to plug, this was an awesome experience, and we're going to keep doing these, and so in 2 weeks, we're going to bring on an M&A advisor who's done over 700 million in these deals, all in the trades. We're going to do that in 2 weeks. And Coast is going to send you an email where you can sign up. This is with Brentwood Growth. They're one of the largest M&A advisors in the trades. So you should get that soon. Or maybe it's later this week. Either way, you're gonna get an email. So please sign up for that. But let's get into the questions. Tom, can you see this question from Steve Little here in the webinar chat? If not, I can read it to you.
Uh, yeah. What are your thoughts on part of a business rate as quality of earnings completed? Yeah. So I think this really ties into when we're looking at financials, getting an audit done. When you say quality of earnings, well worth the investment to do for your business. It's not cheap. The most recent one that went through in January, we had this done. Um, Essentially, what you're doing is a mock trial of having someone come in and go through everything that you have. Because again, here's how it works. When you enter into a deal, there's a letter of intent that's signed, and then the next step is due diligence, where they're going to come in and look at everything under the hood, and part of that's going to be your financials. So quality of earnings, well worth your investment to have done, will certainly help you, especially prepping for a sale and getting ready for that sale process. Hopefully that's helpful.
Yeah, do you mind actually just because I realize not everyone can see the question. So can you just actually even define like a quality of earnings, report what that means, and then also what maybe the budget should be for a QOE?
Yeah, so an analysis, I mean, the quality of earnings is essentially assessing the accuracy, right, of your financials and is it sustainable over the long term. A budget, I think it's between 5 and 10,000, um, depending on the size of your business. Is that what you mean? How much it would cost to have one done? Is that what you
Yeah,
mean?
that's
Yeah,
what
yeah.
Steve followed up
It's an
with.
investment. Again, it's the same thing with getting a business valuation. I think these, in my head, they tie hand in hand because to get a professional valuation done too, it's going to cost $8,000 to $10,000 depending on the size of your business.
Hmm.
So it's deductible. It's a business expense, but well worth the investment if you are committed to again selling something that's valuable over the next 3 to 5 years.
Amazing.
Next, I see. Will you be emailing the recording?
Yeah, so
Liz
we're gonna
got
email out the recording. Someone asked, Scott asked if we're gonna email out the recording, and Lise, I think shared. I'm not sure if you saw it, Scott, but we're gonna email out the recording as well as Tom's guide later today. So you'll see all that stuff coming out, which I think will be really helpful.
great.
Any other questions?
Yeah. Anything else that we see?
I'll ask one for everyone. Tom, if we're interested in hearing more from you or speaking with you and your team at some point, how can folks get in touch?
Yeah. Liz, I think I have two slides. Oh, okay, great. You're hitting me there. Yeah, so here's just a quick couple slides on how we can help. Again, beyond your exit wealth management, we offer wealth management and financial planning for business owners, specifically who are looking to exit within the next 5 years. Some free resources. I have a podcast called Business Exit Success. It's on the apps, the normal apps, Apple and Spotify. You all will get the free exit planning playbook as well. That goes much more in depth on the process than this presentation. And lastly, we do offer a free readiness assessment, which is a preliminary value add that we offer anybody who's considering partnering with us. If you click one more, I think there's another slide there, Liz. Yeah. Essentially, what this is, it helps anybody who's looking to partner with us make an informed decision. So we help you answer questions like how will my cash flow change? How can I maximize my proceeds and reduce taxes? When's the right time for me to step away? Again, this is very different for anybody. So if you have any interest in learning more about that, feel free to hop on beyondyourexitwm.com, set up a call, and happy to chat.
Awesome. Awesome. This was really, really great. And, I know not all of you here on this call are users of Coast and customers yet. So many are. So, as we said before, this is a company that's all about helping you find success. We're about increasing your bottom line with the latest and greatest tools, saving you money. And so if you haven't heard more about Coast and you want to learn more, feel free to go on the website. You can go ahead and sign up on an application. And we can get you set up really easily. Or if you want to hear more from one of our account executives, you can click speak to sales and fill out a little form, and we can actually do a custom assessment for you on Coast and your financial position for your fleet expenses. So all stuff that should hopefully again help you get yourself in that amazing position to have an awesome exit. But for now, we'll send out a little form for feedback. We'd love to hear your feedback on these sessions, and we'll see you next time. Thank you so much, Tom. Appreciate you, man.
Appreciate it. Thank you, everybody. Appreciate your time and attention.
Bye, everyone.
Take care.